So now I'm going to talk about the money market in which changes to money supply and money demand affect the interest rate. So remember, the interest rate is a lot of purposes. It's the price of capital, it's the marginal productivity of capital, it's a reward for savings or patience. People put money in the bank for later and then they're rewarded with interest. Likewise, the interest rate is sort of a penalty. If you want money early, you can take out a loan, in which case you're paying more money now for access to money that you don't own yet. So the interest rate is really important, and determining interest rates affects a lot of investment decisions. It affects currencies and has a lot of implications. It's the most important price in macroeconomics. So this interest rate and what determines interest rates is one of the most important things in macroeconomics. Now, money pays no interest, but money can be used to purchase things that do. And so in general, the trade-off is between money and bonds. If you put your money and hold it in cash, you are foregoing the opportunity to hold an interest-bearing asset. And so the opportunity cost of holding money is interest. The interest you are no longer able to earn on an asset or a bond or something that does accrue value over time. So there is a price of money, right? Because you're not holding something valuable. So it's the opportunity cost or a price, and it's also tied to the productivity of capital. It's the marginal productivity of capital. So interest rate is a number of functions. Here we're going to say it's the price of access to money. All right. So money supply is controlled by the Fed. It's going to be an independent relationship, and I'll draw that second. Let me draw first. Money supply. It is not dependent on the interest rate because the Federal Reserve can choose the value of money that it puts into the economy. A private bank might need to raise rates to draw on deposits, but the Fed does not. So it's an independent relationship, it's completely vertical. Money demand has three driving forces. There's precautionary demand, which is basically the unknown. People hold money for risk, which is not part of the graph. But transactions demand basically says if Y goes up, money supply goes up. This is a shift in the money supply, the money demand curve. So this drives the shifts to the right or to the left. So more income means more need for money, less income means less need for money. Speculative demand basically says if R goes up, money demand goes down. All right? And so that, in other words, if interest rates are high, there's a higher opportunity cost. People will hold more bonds and less cash. All right? And so this is basically the slope. All right? So in other words, if you were to draw, higher interest rate means lower money demand. Lowering the interest rate creates higher money demand. You're going to have a downward sloping curve. And so that would lead to an equilibrium interest rate, or equilibrium, where money supply equals money demand. And this is equilibrium R. All right, so that's what drives money, or the interest rate or the price of money in this market. So downward slope is speculative demand, and then the shifts are going to be the transactions demand. All right, so this is the equilibrium interest rate. So it looks like a standard supply and demand model, except for the fact that this is an independent relationship. Now, what causes the shifts? As I mentioned, it's really just two things. Money supply is going to shift left or right based on what the central bank does, and then income is going to shift money demand. And so I'm going to draw two things that increase money demand or increase interest rates, and then I'm going to draw two things that decrease interest rates. They can be done separately or together. So if money supply goes down, right, then you would see that interest rates go up. So a cut in the money supply through open market operations, which we've seen before, which is basically the Fed is going to be selling bonds, lowering the money supply. That is how the Fed raises rates through that process. But that's a cut in the money supply, which leads to a higher equilibrium interest rate. Right? At the same time, you could say, well, let's do a second cause just simultaneously, money demand. All right, and that could be higher income. All right, so if the Fed cuts the money supply at the same time as people want more money because they have more income, you would actually see interest rates go up even more. All right, so that's one cause or one shift in the curve. So two curves simultaneously make this move together. So what about two decreases? All right, so secondly, the Fed can cut rates by increasing the money supply. That's what the U.S. saw after the 2008 recession, was a lot of bond buying, increase in the money supply, which lowered interest rates nearly to zero. All right. At the same time, there was also a recession. Lower income because of the recession meant people had less money to spend. needed less money or demanded less money. And so both of these together would actually combine to be a decrease in interest rates, and that was one reason why interest rates were the lowest they've been in decades, right? So this can be drawn separately. Increase in the money supply lowers rates, or you could say drop in income lowers rates. I just drew them together and said both combined lower rates even more, right? So that's the money market. You have supply and demand, looks like regular supply and demand with a price. Quantity I did not draw because the quantity of money is not as important. But what we're saying is what makes the price of money go up? What makes interest rates go up and down? And so we can draw this market, talk about the supply controlled by the Fed, the demand controlled by income and bonds and other purchasing, the desire to make interest elsewhere, and combine them to get equilibrium interest rate. Changing the money supply or changing income makes this interest rate go up or down. This is used for anybody buying a house, buying a car, businesses that invest. It also affects demand for the dollar overseas. So this is the most important price in macro, all on this market here.